Okay, so the legal ways to pull money off a credit card. All right, so we're gonna go over four different ways today. Four ways on how to do this. Number one, a way that most people know, but people don't take advantage of, and that is doing a balance transfer. And as people pop in my mods, you guys can definitely let them in the Zoom as well. So with a balance transfer, most credit cards offer 0% interest on a balance transfer for anywhere between 12 and 18 months. We have actually three different things from a charging standpoint. We have a balance transfer, we have cash back, which we never recommend a person do because cash back, you're always going to get charged. Meaning I want to just take the cash directly off the credit card, no balance transfer. Just, hey, I got money in the card, give me cash. Strongly recommend against that because that's always going to be at the APY, not an introductory APY, but the APY, which is usually in between 10 to 30%. And then number two, it's usually a 5 to 10% fee to do cash. So you never want to take cash directly from a credit card. So you have, again, balance transfer, cash, and purchase. And then, of course, if you buy something, sometimes it's 0% APR if it's a new car, or it might be the standard 10, 15, 20% of interest. But here we're going to specifically talk about balance transfers because if you do a balance transfer, you can get it at either 12 to 18 months, whatever you transfer off that card and not pay interest over that time period. So instead of transferring a balance to another card, because what credit card companies let you do, they allow you to transfer card from one to another. So it's a strategy that people use when they want to pay off a card. So let's say I have a $5,000 credit card, and that $5,000 credit card, I owe 20% interest on, right? And I got a new credit card. So that new credit card that has $10,000 on it, I can do a balance transfer and transfer the balance at 0% interest from my card and basically kind of pay off my old credit card. So if I am having $5,000, they're charging me 20% a year. That's $1,000 of interest. So by doing that, I save myself $1,000 of interest I have not paid toward the card for interest. So, but we take it a step further because it is a way that you can do a balance transfer to US cash, as we'll talk about. So you have the credit card company, they mail you the check. So instead of them deposit the money into your account, because credit card companies, they don't let you do that. They do not let you actually get money via balance transfer and send the money directly to you. They don't allow you to do that. They want you to do, as I said before, a cash back when you take the cash back, right? That's how they give you the money in your account because they know they're going to charge you. But what you can do with a balance transfer is that you can ask the credit card company to not transfer from one account to another, not transfer from one credit card to another, but ask to do a balance transfer to send you the actual check. So when they send you the actual check, that check is now cash. And we're able to then use that cash however we want to because now that is cash. So by doing the balance transfer and having the credit card company send you the actual check, we deposit that check, that turns to cash, and voila, we've taken cash off an account, off our credit card. Now the rules still apply, right? You will have it between 12 to 18 months. Again, you have it between 12 to 18 months to basically pay that back with no interest. If you fall after that 12-month time period, or you fall after that 18-month time period, then usually that interest goes up to 30%. So you definitely want to do some type of balance transfer before that happens to transfer the balance that's left into a new card that has 0% so that you can pay the interest. And it's a structure how to do that. But by doing a balance transfer, make sure if you want to pull the cash that you call the credit card company and they mail you a check, right? Just effectively turns your credit limit into cash with no interest for that promotional period. And as I said, that promotional period might be 12 months, might be 18 months, might be 24 months. Discover does this a lot, 24 months. And we want to use a real example because Discover, you probably see the commercials a lot. From my experience, Discover is the one that does the most from a balance transfer standpoint, where they'll, do 12 months, 24 months. 18 months of no interest. A real example, because, of course, the last have, thousands of clients, throughout my now 18 years of practicing, can't believe it's almost 20 years I've been a financial advisor, a licensed financial advisor. Pretty cool. Okay, but so real example, what we did for a client actually last year, and that is that they got approved for 0% APR balance transfer with Discover. That credit limit was $17,500. So the most that they could take off that card was $17,500. As I said before, we did not do cash back. We did not want them to take it out, right? And we also not have them the balance from one credit card to another because they didn't have any credit card debt, right? So to do that. But they did have a roof. They did have a problem with their roof. And either two things we could have done: either take money out of their retirement account. So when you take money out your retirement account by law, when it's all said and done, you can either do 10%, 15%, or 20%. From a tax standpoint, we say in their case 20% because they were higher income earners. So if they took out $15,000 out of their retirement account, two things would have happened. Number one, that's a $3,000 tax bill, right? So that's like 20% interest. So they're paying the IRS $3,000 that they'll never get back. And then also it counts as income. So if they want 15,000 in their pocket, $3,000 goes to Uncle Sam. That's $18,000. So on their tax form that they got, the 1099 from us, it would have showed as if they went somewhere and made an extra $18,000. So that boosted up their income, which means they may have to pay back taxes at the end of the year. And we don't want that. We don't want to pay Uncle Sam if we don't have to. So we used the strategy. So what did she do? She called Discover. Discover did the balance transfer, sent the check to her. So she got that $15,000. And with the $15,000, she deposited that money and then wrote a check to pay off her. Now, for her, she did have 12 months to pay because it was a 12-month interest free. So she had basically 12 months to pay off that card. She got the cash, so she had 12 months to pay off the card. But by doing it that way, it just allowed her more wiggle room to use her money that she was getting. This was a retiree, so she was getting from her pension and also her Social Security to kind of use that money over the course of a year to pay basically $1,200 a month, which is $15,000. So she paid it off in 10 months. Well, she's still paying off now, but we're scheduled to have it paid off in 10 months. We did this back last September. So basically, as it stands in July, she's going to have the card paid off. So the card will be paid off. They didn't charge her any interest, which is great for her. She didn't pay Uncle Sam any taxes, which was great for her. And her income didn't go up last year because she took out $18,000. So by using this strategy, she was able to get everything paid off. Now the question may be, well, why didn't she just do it on, why do it this way? Well, again, the reason why is because it just allowed her to have it paid off month by month by month. So, but it's warning though, right? Because some banks charge a balance transfer fee at 3 to 5%. So, when you're doing the balance transfer either to another card or calling that card company, having them send you the cash, then you want to make sure that you also account for the 3 to 5% fee. Then also caveat, the roofing company that she was using, they only took cash because, some companies take cards. Now you see, and actually a lot of companies now, like they don't even take credit cards anymore. They take debit cards because, the scammers be scamming. Sorry to say, but the scammers do be scamming. So you're actually seeing a lot of companies now, like they're not even taking credit cards as payment. They're taking either debit cards or they're taking, because of course, even with a credit card, you might do a credit card and 3 weeks later you do a chargeback. Now they got to go back and forth with the credit card company with the chargeback, justify that it did the services and just time. Because again, people be scamming. That's something that we've kind of seen lately. A lot of companies don't even take credit cards as payments. They either take cash, check, or a debit card. But for her, it was cheaper for her to have them do it, and she paid them cash instead of a card. I think it was like a 15 or 20% discount for her paying cash, so that's why she wrote the check. So that basically transferring, let's transfer wise money to you in the form of cash. Any questions there before we go over the second scenario on how you can pull money off a card to you? So we got a question. Will the credit card company question why you want the cash versus having the available money on the card? No, I mean, in the words of Brown, is your prerogative, right? They approved you for the credit card. You can use the credit card for whatever you want to. So I have not seen individuals do this strategy and had credit card companies question them. Now, the credit card might ask you to do a cash back instead, because they might bring up that option, because from a credit card company standpoint, they make more money by the cash back, because usually when it's cash back, when you just do it like a cash purchase and they give you the cash, they never do a 0% APR there. It's always either 10, 15, 20%, depending on what your interest rate is on that card. And then also they charge a 3 to 5% fee to pull that cash off the card. So they might recommend that you just do cash and get it quicker. They might recommend that, but as far as the question why you're asking for a check, I have not seen that. Not saying credit card companies don't do that, but in my experience, having clients go through this process, we have not seen that. That is a great question. What are the questions do we have about the balance transfer? Why we want to do a balance transfer and how we can do it and get the cash? Make sure we don't have any other questions. All right, cool. No other questions. All right. Again, if you guys have one, you can just message me or message the mods will let us know. All right, so that's number one. That is number one. So then number two. Too far, Mario, too far. So this is for business owners. Because we like to talk about, personal individuals, business owners, but for business owners specifically, using Melio for your payroll. So Melio is a company that allows you to pay them via credit card payments, and they send out cash to providers. And this specifically is for payroll, because for payroll, you got to pay it. If I am a small business owner with one employee, I'm paying myself, or I got multiple employees, I got to pay my payroll. And typically, payroll companies do not take credit cards because, again, scammers be scamming, people be defaulting. So most payroll companies, they do not take the actual credit card payment as a payment for payroll. They want directly out of your bank account. They would take debit cards. Like we have our payroll through paychecks. The reason why I don't use this strategy, because for me, I don't pay, because my wife, who moved here 18 years ago, her first job before she became a homemaker, taking care and hold down the fort all these years, her job was with paychecks. So I literally $1. We pay $1 for my payroll. Even though we have 11 employees on payroll, I pay $1. So instead of paying literally hundreds of dollars on a bi-weekly basis, I pay $1. So for me, our business is actually cheaper for us not even to go through this process. But for most individuals who are paying, money from a payroll standpoint, we strongly recommend this. We have our business owners do this, and it helps them dramatically, and we'll kind of go why. It's primary business-to-business payments, right? So you can pay vendors, contractors, payroll services like ADP, like Paychecks, like Gus. From my knowledge, though, ADP is the only one that lets you do this. Paychecks and Gusto, you can use it from a tax reporting standpoint, but they don't let you use the strategy. It's only ADP as of today. Using the credit card, and then again, Melio ACHs it to them, right? So it is a fee. Anytime we process a credit card payment, it is a 2.9% fee. So for every $100 that we do, this note $3 is going to go to Melio for processing it that way. Then also it's direct integration into QuickBooks, Gusto needed payroll processes. So from a bookkeeping standpoint, by doing it this way, they file everything, so everything is squared away from a tax write-off standpoint, because when you have payroll, you get to write off the payroll cost, you get to write that off. And actually the 3% fee that Melio charges, you get to write that off as well. So all those are actually tax write-offs, and it's directly integrated with QuickBooks, Gusto, Wave apps, which we think is the best one to track all your bills. So if you guys are small business owners, I would strongly look into using Wave apps, PS, and my mod, y'all can put that into the chat. It's called Wave apps, WAVEAPPS. I'm not getting paid, so it's not a paid commercial or marketing or advertisement, but their flow, how they do things, how they get all your information, and then do bookkeeping for you at no cost. So instead of paying a bookkeeper. They do the bookkeeping for you. You just have to just kind of check off that everything's correct once a month. They send the reports directly to your tax preparer, so it makes it a lot easier. You can justify your expenses from a write-off standpoint a lot easier using Wave apps. So yeah, and I've used QuickBooks for years, but in my opinion, Wave apps is a lot more easier and it's cheaper than QuickBooks as well. I know I got a tangent there, but trying to save y'all money, right? So Melio increases your business credit score and it gives you money back. So kind of how it works, right? So anybody, again, as a small business owner, you can either use ADP or Paychex or Gusto. Those are the three big companies that do payroll for small business owners, right? So you're using, let's say, ADP because ADP works with Melio and you're paying employees, or you're paying yourself. So if you're a single entrepreneur, you're paying yourself. Anybody making over $50,000 a year as a single entrepreneur, strongly recommend that you go through the process of going from an LLC to an S corp. If you want me to get into why, definitely in the chat, let me know, and I can kind of explain why. But anybody who's a single entrepreneur and you're making more than $50,000 a year, you are setting yourself up for tax failure every single year if you are still as an LLC. You want to change that from an LLC to an S corp. It is in between $3 to $5 of actually tax savings you have by making that change. And then I can go into that more detail. But over $50,000 as a small business owner, you need to structure that as a S corp. But Melio pays your employees, so it goes through ADP, and then Melio is the one that actually pays your employees, not you. So Melio pays your employees as if it was from your bank account. Because like I said, payroll companies do not take payroll via credit card. So Melio is the one that's going to pay your employees. And then Melio is going to charge you. So then they're going to charge your credit card that you have on file, right? So let's say it's $10,000 in payroll. Melio will send that $10,000 to your employees, and then they will bill your credit card $10,000 plus that 3% fee as well. It's a rough, but it is a fee, right? So yeah, that's how that works. So if you do this strategy, I would recommend one credit card in particular, and this is the MX Business Go. The reason why is because they give you 4 points, extra points. So if you have 1 point, they'll basically give you 4 extra points. So they give you 4 times the points if you use things towards marketing, advertising, or travel. And for business owners, it's great because all business owners, some way, somehow, they market, they advertise. I don't know if they travel, but they definitely market and they advertise. So you get 4 times the points for anything related to marketing and advertising. And also, it increases your positive payment history because if you use Melio, since it is a high balance that they put on your credit card, you pay it off immediately, right? Recommend usually people work payroll on Tuesday or Wednesday. That needs to get paid off on Friday because it's the same money. If you did it not using Melio, you did it through your bank account, your business bank account, or your operating bank account, it's going to go directly to your employees anyways. So the money's going to be gone one way or another. So instead of waiting and having that high balance on your credit card, we want to have Melio do it. We pay Melio off Friday immediately. So that looks positive because you have a high balance that you pay off immediately 2 weeks. That's going to help your FICO score dramatically. So basically, you're getting $1.50 per every credit card point. So that means for every $100 you spend, you're getting back about $50. I mean, it's a pretty good investment, right? If I spend $100, I get back $50. That's good. And that cash back that they give me, again, we use that towards marketing, advertising. It's a way for you to basically have free money by doing the same thing that you're going to do because you're going to pay your employees. But if you do it this way, using this strategy, you get free money and you're boosting up your business credit, which is great. So an example, because again, we always like to use real world examples. We have clients that are using this strategy, but kind of particular, they have a small HVAC company here in Jacksonville. Can't say the name, but they're actually here in Jacksonville. But they have a HVAC, so heating, vacuum, and air. Anybody who's might know who they are because, of course, we get people refer. So when people call and say, "Hey, who do you know who does AC work?" This is a company that refers. So if you guys have asked that, then you know who they are. But can't say their name. But yeah, so their payroll bi-weekly $20,000. They're a small business. They have about, I think, 4 or 5 employees plus the owner. It's $20,000 every week. That's their payroll. They're basically paying the employees, and the owner taking a small amount as well on a biweekly basis, right? So when they do this, they do it through Melio. So Melio is paying the employees $20,000, and then Melio on their American Express school card is billing them $20,000 plus again that 3%. But again, since they are able to use this from a cash back standpoint and give that back towards marketing, they are getting a lot of money cash back for marketing by itself. So even after the 3% fee from Melio, he gets basically $3,200 a year cash back. So literally, by paying his employees, doing something that he has to do anyways, at the end of every single year, he's increasing his credit score because he has a large payment that's being paid off every single 2 months. At 3% charge, he's writing off, but he's getting back $3,200 every year. Now, $3,200 a year might not seem like that much. I mean, that's like a person makes $50,000 a year. That's like 1 month's pay, right? And if you think about that over time, $32,000 a year. Let's say we do this for 10 years. That's $32,000. By using this strategy 10 years from now, he can use that and buy equipment that didn't come out of his pocket. That's money that American Express gave him just by using the card. So anyone that is a business owner would strongly recommend you use this strategy because you're going to get free money. You're going to increase your credit for your business, and it works. And if something works, then we want to take advantage of it. So that's how we'll pull the money off, because we can't do it just the right way. We can't pay our payroll through a credit card company. So it's a indirect way to pool cash to pay employees, pay it, and then we get paid for it from a cashback standpoint. So I hope that helps. So we talked about WhatsApp. So any questions there for business owners about using Melio and using ADP to allow them to have payroll payments to employees and have Melio charge them, but then of course they get all those write-offs and cash back. Any questions there? Y'all didn't see somebody's text me. Y'all see my slides? Okay. I was just talking. Y'all see my slides? Oh boy. Okay. What slide did you guys not see? My apologies. Somebody put in the chat mine. Can y'all see my slides? You can say, okay, cool. Awesome. All right. So again, for my business owners, anyone has questions on how to use that strategy? Does anybody use that strategy? How about that? Because, when I explain it, it's like it's foreign. It's like I'm speaking Mandarin. When we meet with our business owners that become clients, we kind of go over that strategy. They're like, what? Can you do that? Is that illegal? Like, how can I do that? Has anybody that's a business owner used that strategy before? And you could put a 1 in the chat if you have, and put a 0 in the chat if you have not. Or you can just direct message me, yes or no, for my business owners. Okay, I got 3 DMs with no. Well, y'all need to, because it's a way. Because if we have payroll, we have to pay our employees. Like, you have to pay your employees. The money's coming out of your operating account anyways. So if it's a way that you can boost your credit score with your business, your FICO score, and also get money back, giving money to you by paying your employees, like, why wouldn't we do that? We strongly recommend any business owner use this philosophy, use the strategy. Call us, we can definitely got to help you get it set up and talk about it in more detail with your actual numbers and payroll. But it's something I would strongly recommend. Strongly recommend. So next, it's for everybody now. So everybody, doesn't matter if you're a business owner or we are, W-2 employee or retiree. Use plastic and pay simply to pay expenses that credit cards don't normally take. So it's also 2 companies out there that allows you to do the same thing that Melio does. Now, Melio is typically for business to business. Seek, Plastiq, and Pay Simply. These are also 2 companies that allow you to sign up with them. They'll pay something via cash, and then they'll bill your credit card. So these are 2 companies. These companies allow you to pay rent, mortgage, tuition, card payments, and then vendors using your credit card. So again, use your credit card because typically you can't pay your rent or your mortgage or car payments using your credit card, but it's a way that we can indirectly do that, right? Now they send the funds to you via cash, and then they bill your credit card. So you get the cash, send it to them, and then they bill the credit card plus 3% fee. Now this converts credit cards into usable cash flow. Now, we don't recommend this strategy to everybody because you are paying that 3% fee. So when we're paying our mortgage, we're paying our car payment, insurance, our health insurance, we rather you use money. But it is certain examples on when you should use this method. But 95% of the time, not 100, because nothing is absolute. But 95% of the time, definitely we want you not to use the strategy, but we want to explain that it's out there. But we recommend that you only use this strategy in these kind of instances. Number one, if your credit score is between 450 and 650. The reason why is because a credit score that's 450 to 650, you are building your credit to kind of get to that magic number, and the magic number is 720. Having a 720 credit score, that's kind of the magic number where you really get to dictate how much interest you're going to pay. You get to call your credit card company and say, "Hey, I want you to decrease my interest rate. I want to get a credit limit. Increase. I want you to give me more money. I want to get on the card that's 0% interest." You have a lot of negotiating power with your credit card company, or any other companies that you do to get a credit card once you have that 720. But for people that are building up to that, they don't have that cachet. They don't have that clout per se. So we need to build up our credit. And by paying as many bills as possible using credit and then paying off those bills before the statement date so that we don't have any interest charged to us and it looks good on our credit report, that'll help. And as I talked about before, I recommend all of our credit cards being paid off week by week. Because as we talked about, and I explained it again for people that weren't on the first time, from a credit standpoint, each time you pay something off, that is 1 to 2 points on your FICO score, right? When we fall under our utilization rate, which is 35% of how your FICO score is calculated, that also helps our credit score as well. So by doing those two things, literally, if you have 4 payments, we pay those off once a week. That is going to boost your credit score by in between 8 to 10 points. So we do that on 5 cards, let's say throughout the month, that's going to boost our credit score by 40 to 50 points. So we're not going to do this for the rest of our life. We'll do this for 3 months, 4 months, 5 months, 6 months. But by doing this philosophy, you are going to be able to quickly boost your credit. So yeah, cool. Oh yeah, we had a question. So you definitely get a replay. Everybody who signed up, you definitely get an automatic text email this time tomorrow with a replay of everything. So yes. So that's that. So again, it increases your payment history positive. And anytime we have a positive payment history, that increases our FICO score, right? 30% of our FICO score is payment history, 35% is utilization rate. So we're paying something on time, that's positive, and that makes up 30% of how our FICO score is calculated. A low utilization rate, as I just talked about, utilization rate is 35% of your FICO score. The utilization rate should always be less than 30%. Meaning, if my credit card is $10,000 of credit limit, I should have no more than $3,000 on that card. So when you hear people say, I only have one credit card, I have 2 credit cards, I put everything on one credit card, it's good if you're paying it off, but you're actually working backwards. Because if you're paying it off each month, it's still hurting you because of your utilization rate. So let's say I have $30,000 on a card and that's a lot. Let's say I have $10,000 from a credit limit standpoint, right? And I always put $5,000 on that card, but at the end of the month, I pay off that card. Well, that's good because you're paying off the card. Hurts your FICO score because on the card, you have more than $3,000, which is 30%. And that's kind of above the utilization rate that credit cards want. What you should do is spread that out. Instead of having one card that has $10,000, we should have three cards that have basically $3,300 a piece. And with that $3,300, we put, 1,500, uh, uh, 15, 1,500 on one card, 1,500 on another, 1,500 on another, doing it that way. So all three cards have a $10,000 credit limit, right? But now we only are putting in $1,500 or $2,000. That's below 30%. So it could be the same bills, the same money, but spread against three different credit cards, and you're paying off on time. That's actually going to help your credit score. By you having one card, putting everything on one card, even if you pay it off throughout the month, that still hurts your FICO score. So when a person says they have one or two credit cards, not good. You should actually have multiple credit cards. So we spread our credit limit higher. And with that, we should have multiple balance on each one and have them paid off each month. That is how we quickly build our credit. All right. So back. I hope everybody understands that. And as I said, great segue, Mario. But that's how you boost your credit score quicker, right? So not for everybody, but for those particular individuals who fall under that parameter, that's what I recommend it. So what's it best for, right? Your rent or your mortgage payments, right? So again, if I fall under that, I want to boost my credit as quick as possible, then I pay my mortgage, because the mortgage, and we like to do this with money that's going to be leaving your pocket anyways. It's not like we're just going to get it to begin it. We're going to buy something and then kind of pay it off down the road. No, we like to use the strategy with things that you're using cash for anyways, because typically when you do a mortgage, you got to do it with your bank account. You got your rent, you got to do it for your bank account. You got a car payment, you got to do it from your bank account. You got health insurance, you got to do it from your bank account. So these are things that were already having money come from our bank account to them anyways, but having a buffer is going to help our credit score. It's also going to help us from a credit standpoint, and we also get cash back as well. And tuition and student loan payments, now that's a caveat, because if we can get student loans, then that's always better, right? We can actually get a student loan by ourselves, because the interest that you pay on a student loan, that is tax deductible, right? So if I got $1,000 student loan and they're charging me, let's say, 10%, which is high, but if they charge me 10%, that's $3,000. That $3,000 of interest that I pay, I get to write that off on my taxes, right? If it's me. Now, if I'm doing it for my child, big difference. If I'm doing it for my child, then I might not be able to write it off. But if it's me getting a student loan for myself, then I'm able to write it off. So yes, if you are paying for your child's education, then you probably won't be able to write off that interest, because it's not you, it's their education, not yours, and then you would do it this way. But as I talked about before, my boss could put this in the chat, it is two ways that you can use payments towards write-offs for college if you're a parent and you are paying for your child's education. The first is the AOTC. I know I'm getting off on a tangent, but I'm just trying to give you guys as much information as possible. See, American Opportunity Tax Credit. My mind, y'all can put that into the chat. It's AOTC, American Opportunity Tax Credit. So for you as a parent, if you're helping pay for your tuition, you want to get the 10T. So 10T, that's going to come directly from the college university that your child is attending, right? You get that to your tax preparer. They fill out the AOTC form, and you get up to $2,000 of write-offs, right? So if you spend $10,000 on tuition or books or room and board, out that $10,000, you get up to $2,500. You get up to $2,500 back from a tax write-off standpoint. So there's a way that you can do it. Also, another way is the and this is for undergrad. This is for a person who is undergrad. You also have the LLC, I'm Learning Credit, not limited liability company, but the Lifetime Learning Credit. This is for a person that's getting their master's or their doctorate. So if you're helping your child with the master's or doctorate, same thing. You need that 1099 from university, but with that, they'll give you up to $2,000 as a tax write-off for helping your child. So that is two ways that you can get write-offs from helping your child with their education. Not do student loans though. AOTC for undergrad and then LLC for overgrad. Yes. Okay, so cool. Let me go back to these questions. Should retirees have multiple credit? Yes. So we had a question from a person. Should a retiree have multiple credit cards? Yes. I recommend anybody have credit cards. Doesn't mean that you're putting money on all those credit cards, but we're doing this for the utilization rate. So if we typically put everything on one credit card, we need to stop that because you're hurting yourself because you're going over that 30% utilization rate. So let's say, again, using that example of $10,000 on $10,000 credit limit. I got $5,000 that I put on that credit card and pay off at the end of each month. Just for 3 credit cards, that's setting $10,000 limit. And now we put $2,000 on each card. We pay it off. Your FICO score is being helped 2 different ways. Number 1, payment history. And number 2, utilization rate is under 30%. So as a retiree, working individual, have multiple credit cards. Doesn't mean you have to use them, but definitely have multiple credit cards. That's a great question. If you have a credit card balance and acquire a new card, can you pay the credit card bill with the new card to split the amount? Yes. So that's another great question. Balance transfer. So any new credit card, you have up to 90 days to increase the credit limit and also see if they do a 0% balance transfer. So if you get a new credit card and the sole purpose of paying off another credit card from a balance standpoint, you don't need them to send you the cash, right? You just do a balance transfer and you can, let's say that credit card that's owed has a $5,000 balance, right? And you don't want to pay it all off for whatever reason, whatever balance transfer amount, you just transfer that balance from the new credit card to the old credit card. You can do a balance transfer, do it that way. If the sole purpose is to pay off an old card, if the sole purpose is to kick cash off the card, then you have the credit card company send you a check. Cash back, like I said, because you're going to be it's no 0% APR on cash back. So great question. And these are great questions, you guys. In your opinion, how important is having a mortgage on a credit card? I heard it can move you 100 points. That is a great question. For certain instances, I just want to be clear. For certain instances, I say use this philosophy or having pay simply or having plastic pay, right? So my understanding is that you cannot have your actual mortgage be paid by credit card. It has to be a separate way. So it moving you 100 points, I can't say yes or no because I have not saw an individual yet be able to actually pay their mortgage on a month-to-month basis with a credit card. So doing it this way, and able to kind of use cash to pay the mortgage and then either pay simply or plastique, bill you, and then you take care of it with your money because the money was going to pay for the mortgage anyways, but have that intermediary that allows you to have that boost and boost and go and also from a credit standpoint. So Chris, I hope that answers your question. I'm asking having a mortgage account added to your report. Oh, I don't know that one. So actually like a mortgage account added to, well, from a credit standpoint, all the bureaus, they look at everything. So if you're paying your mortgage on time or not, they know. So you definitely want to make sure you pay your mortgage on time because they definitely know. But as far as it being reported directly to the credit bureau, I don't know how many points that is. So like if you don't pay your mortgage on time, I don't know how many points that goes down on your credit. I can definitely get that answer, send that to you. A mortgage rate. Oh yeah, I would think because a mortgage has a higher balance. If we got a mortgage that's 200,000 and we got a $10,000 credit card that we're paying, of course, you're not paying that mortgage. I would think would be weighed heavier as well. But as far as the points, I don't know what those points are. But that's definitely a great question though. Great question, you guys. All right. So again, we talked about student loan payments as well. All right. So real world example. So I'm actually doing this for one of our clients. So they work for a small business and that small business does not offer health insurance. So they have to about 2.5 years now. So this is not like something that's happened last year. But with that being said, they have to pay for health insurance out their own pocket because the spouse is not working. So the husband's working, spouse not working. They have to pay for insurance out their own pocket because their income, Affordable Care Act isn't the best for them, right? So their family insurance for last year was whopping $2,900 a month. Yes, $2,900 a month for health insurance. Health insurance is very, very expensive. Retirees know this, right? If you work for your job, it's subsidized. If your job offers it, you're not paying as much, but it is very, very expensive. So they're literally paying almost $36,000 a year. And health insurance, you guys, we got to get something together with health insurance because I think we all could agree, politics aside, insurance is way too high, way too high. All right. So they use plastic to pay their insurance payments. And they use this with Chase Sapphire card. And the reason why is because they do this to go on family vacations, which we'll talk about. So with the Chase Sapphire card, it's two Chase Sapphire cards that you can get. They have the Chase Sapphire Reserve card. And you want to get this, you specifically want to use it for travel because they give you 10 times the points. For every 10 points, they give you 100 points if you use it towards travel. Very important. If you use it towards travel, use it for something else, the points score. So you only get the Chase Sapphire Reserve card if you specifically want to use that card to accumulate points for travel only, because it gives you 10 times points. That is a lot of points. Or you can use the Chase Sapphire Preferred card. I personally have the Chase Sapphire Preferred card. They give you 5 times the points for travel, so not as much as the reserve, but you get other perks when it comes to the Chase Sapphire Preferred card, which I actually personally have. But they use the Chase Sapphire Reserve, and they only use this card just for insurance. Right? So with those 10x travel points, they use it to literally pay for a family vacation every single year. So the fees, because again, using plastic and using pay separately, it is a 3% fee. So on that 36,000, the basic paying fees of $360 a year. But they pay fees of $360 a year, but they're getting back from a travel standpoint $6,000. So literally for the last 2 years, they have not paid for their family vacation and they have not used any extra money to do it. They're using literally the same money that they were spending for their health insurance, having to go through, they use plastic. You can use either pay simply or plastic. They use plastic. Have it go through plastic. Plastic sends the money. Plastic bills their credit card. They use that cash that they was going to use anyways to pay for that health insurance premium to pay plastic. Since it's through Chase Sapphire, when they book travel through Chase Sapphire, they get 10 times the points. And for the last 2 years, they've took a very nice vacation. Vacations are expensive, right? Think about flights. They got 2 kids. It's expensive. But the last 2 years, they have not paid a dime in travel, which is $12,000 because of the strategy. If they do this for the next 10 years, of course, in the next 10 years, what's going to happen? Their health insurance is probably going to go up in the next 10 years. And also the cost of a vacation in the next 10 years is going to be more than $6,000. But literally to do this for 10 years, that is $60,000 of money that they did not use that stayed in their pocket. Because, we all like to take vacations. We all like to get away, get away for a weekend or a week. So we all vacation somehow, some way. So they're going to do it anyways. So how about they save money? So $60,000 of not spending on a vacation that could be invested, that could be paying down the mortgage, paying down debt, whatever you want to use. But that is real money. So in that case, yes, actually the credit score is higher than 650. So that's a specialized case where because they're not offered health insurance, you can't put health insurance on the credit card. It's money that they were spending anyways. That's why they use that strategy. And every single last 2 years and going forward, they're going to use the strategy and not have to pay for the family vacation using Chase. So yeah, let's see here. So great question. Are department store credit lines weighed that same as major credit cards? And what is the impact of closing shopping cards? Great question. So me personally, I don't recommend closing any cards, right? Just keep them open, pay $5 on it. Because again, it shows from a credit history standpoint. When you continue to pay off a credit card, that is positive. So look, you can have a card like I talked about this, I think, last time, but when I bought an engagement ring, it was through Shane Jewelers back in 2006. I got married to my beautiful wife, Sarah. in 2007, but in 2006, I got a Shane card. It was through Wells Fargo, but the jewelry company was Shane's. I have like, is a net, maybe Sarah, you're here. It's either a Netflix or a Hulu, is actually on that card. And literally it pops up, it was automatically paid. So literally a long time, 19 years. Wow, 19 years. Man, we've been married for 18 years. I love you, Sarah. But yeah, 19 years we've had that card. You know how good that looks to have a positive payment history for 19 years? So yes, if you have a card, I never recommend closing it. Put something on it, have it automatically paid from your bank, so you don't have to worry about it. But the longer your card history is, the better it is. So I would never say close a credit card. As far as is a department store credit card, way they're not. Typically, most department stores are tied to a company. It might be tied to Citi, it might be tied to Discover. Again, the one that we had was through Wells Fargo, and Wells Fargo has switched to Symphony Bank. So it was Wells Fargo about 6 years ago. It switched to Symphony Bank, so they might switch. But I don't know what weighs more, but they are done through financial companies. Like, so if you have Belk card through Belk, it's not through Belk. You know, Belk has a third party who services that credit card. So yeah. So let's start with the credit cards. Okay, Chase, Marriott, my thoughts. iPhone said Chase, Marriott, credit cards. So if it's a travel card, me personally, because you get more points directly with the credit card travel, I recommend using them. So if you have like Amex, they have like their own website where you can book travel through them to get the most points. With JP Morgan, it's ultimaterewards.com. Anybody with a Sapphire card, your Ink card, Reserve card, ultimaterewards.com is where you book the travel. And that's where you get all those points. So from a travel standpoint, I personally don't like using like Marriott or using Hilton. I like using the actual credit card because you maximize the points. That's just for me. Chris, okay, cool. So I hope I answered your question, Chris. All right. So any questions there on example? We have one more, because for business, for W-2 individuals, we want to be business owners. But any questions here on why you can use this philosophy using either plastic or use it pay simply to pay things off, boost our credit, or in their case, get literally a free vacation every single year with the same money that they have. Any questions? Y'all keep the questions coming. This is great. Great, 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 great. So the last thing, use a credit card to create business income. So the issue that individuals have as business owners as they start is that they don't have any business credit because they don't have income. And in the tax code, right, we have it where we can have write-offs for a certain amount of time. It's not like you have a business and you have all these write-offs and you have income for 10 years. It has to be a time where you start getting income. When a business first starts, you usually have to spend money to make money. The IRS knows that. So, if you have write-offs, they'll let those write-offs, they'll pass through from your LLC, your S Corp to you personally to help decrease your tax liability as a person when you file your taxes for 2 or 3 years, for 10 or 15 years though, right? But this is a way to start creating business income. So we now have more write-offs and also we can then kickstart our business. So business to business invoice plus credit card strategy, which we'll talk about. These are services like consulting fees, marketing and advertisement. It's not hard labor. It's more kind of intellectual, not a hard manual labor, which we'll talk about. And also use payment processing companies like Stripe and PayPal, right? So anybody that sets up a business, I only recommend that you use either Stripe or PayPal. It's pros and cons to both of them. Stripe takes longer to get paid. So let's say a person does an invoice on the first. Stripe takes a week to 10 days for that money to go from your Stripe account to your bank account, right? PayPal is usually 3 or 4 business days. So if a person pays an invoice on the first, you get that from PayPal to your business account like in 3 or 4 days. So you get money quicker using PayPal. But PayPal, and anybody who uses PayPal, you guys might know this. PayPal will freeze your account very, very quickly. If they think it's a suspicious activity or you got a lot more income for the month than you did before, they will freeze your account. And then you have to contest it. You have to show receipts, show what you did. It's just a hassle. Stripe, they're a lot more lenient unless something is fraudulent going on. They won't freeze your account. So it might take longer for you to get but you don't have to worry about Stripe freezing your account. depending on what you want to do, either PayPal or Stripe. All right. But you definitely want to use those two companies when you start a small business from an invoice standpoint, because people pay stuff via invoice. So either Stripe or PayPal. So how does it help your business? So paying yourself a higher reasonable W-2. The two salary allows you to claim more business deductions. The more income you have, now the more deductions you have as well. And it also reduces your tax exposure by deducting management fees because, of course, you have more deductions. So with that being said, exactly kind of how we did this and why we did it. So I have a client who's an engineer. So he's an engineer. He has a W-2 job, and a real estate agent that that bought the house for him and his spouse maybe 4 or 5 years ago. Anyways, it's like, hey, the engineer came to me and said, how can I create capital that I can use to buy a house? So I had a relationship with a real estate agent. So what he did is that instead of going to the bank, being charged interest and go through that whole process of getting a loan and taking 60 to 90 days and all that stuff as well. Didn't want to go through that. So he had some credit cards that was 0% interest. So we used that. So we created a strategy. So we had basically 3 credit cards. We didn't take the total amount. I think each one, they had like a $15,000. I think one had $20,000 credit limit, but it was under his utilization rate, right? But he pulled out those 3 credit cards, $20,000 in total. So those $20,000, he did that, and he got an invoice from the real estate agent, and the real estate agent basically did this coaching. So the real estate agent basically, what she was doing anyways to help buy houses, she used that from a quote unquote coaching standpoint, coaching what to look at a house, not to look at a house. So she kind of did her job that she was doing. Now with the IRS, very, very important. It is Rule 162. And Rule 162 means anytime you charge a person anything as a business owner, anytime you have a write-off, more importantly, and paying yourself. So write-off, charging a person, or expenses. It has to be reasonable, ordinary, and necessary to your business in the pursuit of income. Meaning, the IRS does not have a Rolodex of how much you should pay yourself from a salary standpoint. The IRS does not have a Rolodex or a scroll of what you can write off and what you can't write off. It is not. And that's why the IRS, that's why so many people find loopholes, which we're talking about today, with the IRS and finding ways for you to get more money in your pocket. Because as a business owner, if it's reasonable, ordinary, and necessary to your business and the pursuit of income, you can just probably write that off. So yes, so the real estate agent, she invoiced it, she got that. So that $20,000, they said, hey, since you taught me, let's go into this deal together, right? Let's go into this deal together, and let's then use that $20,000 that you got, real estate agent, and we're going to use this on a down payment on a house together, right? Real estate agent said, great. Okay, cool. He said, great. There's a way for him to pull the money off and also get into a house to start a real estate portfolio. So they did that. They used the $20,000 as a down payment on a rental property together. So now, what do? They got a house. And anytime you get a house, we never recommend selling the house. We always recommend you want to cash out and refi. They did that. He pulled out the $20,000 and they did it for another house. But since they have a rental property, what do? They use the debt, right? They use debt of $20,000 to buy an appreciating asset. So again, move the $20,000 to her. That $20,000 because she coached him, talked about real estate. She could charge whatever she wants to charge because IRS code 162, reasonable, ordinary, and necessary. Use that $20,000 that she received from him from the credit card, right? Put it into a deal, and now they use debt as a appreciating asset because with the house, of course, it goes up time, theoretically speaking. Plus, they get rental income. And they had a structure where he's the one that gets the rental income, right? So then the rental income is used to pay off the credit card in now 18 months. He had 2 that was 0% interest, 18 months, 100% interest in 24 months. So literally now, instead of getting a loan at the bank, that would, because it was a time frame to kind of get the house, instead of getting a loan at the bank, that's going to take, 3 or 4 months. It's going to be, because interest rates are high right now, it would have been about 8 or 9% interest, 0% interest, right? So it saved him about $4,500 in interest payments, and also saved him not losing the house either. So now with the rental income, then guess what he's doing? He's paying off that credit card. So in 18 months, the credit card is going to be completely paid off. He has a house. And guess what they did? As I said, they refinanced the house. They took the cash out of that. And then they're now on to their now third house because they did this twice. Well, that was houses with the money that they cashed out of. So it's a way for you to, as a W-2 employee, right, use the tax code and use debt to turn it to cash and buy that, in this case, towards real estate. Now, we get the question a lot, should we do this with stocks? Now, I love the stock market. I want to be diversified because diversification is the key. However, anytime you pull money off a card from an investment standpoint, never recommend stocks. And the reason why is because even though stocks are tangible, they're not physically tangible. So you can get collateral on a stock, just like you can use collateral of your house. But physical collateral is always better than paper collateral. So, you can collateralize your stock. It's not like something physical. It's not physical. And from a collection standpoint, from a bank standpoint, from a loan standpoint, banks look at things, they like things more from a physical collateral standpoint than a stock. Like you can do a collateralized loan in your stocks. We have people do it all the time. They borrow money against their stocks instead of selling their stocks. You can do that. But from a banking standpoint, from a tax write-off standpoint as well, you get preferably favorably, that's two words, but it's more favorable. I'll say it that way. It's more favorable by doing something from a taking money off a card standpoint to do towards real estate, not to stocks. I'm not saying stocks are bad. I love stocks. Historically, the stock market does better than a house. On average, the average house appreciates by 5% a year. An index fund over the past 20 years has made it 11%. It don't seem like it right now because the market's down, but the housing market's down as well. So we're not recommend use a strategy to buy stocks. We want to use this to buy real estate. So yeah. So I think that